What if I told you that the market tells you exactly what's going to happen in the future every day? And what if I said that it shows you all of this through volume? Would you pay attention? Yes, it's true. The market's real voice isn't in its price, but in its volume. This is where our journey begins. Chapter 1, Part 1. Many people come into trading relying on indicators, spending money on fancy tools, and yet repeatedly make the wrong decisions. Why? Because they only see the surface level. They only see the price. But price never speaks alone. Price always moves with volume. And volume is the language that tells us which movements are real and which are fake. The author says that understanding volume analysis is like understanding a secret code. Once you learn to decode this, the market becomes an open book for you. You can see where big players are accumulating, where distribution is happening, where traps are being set, and where smart money is quietly taking action. The first step to understanding volume is not to see it as just a number or a bar. Volume means commitment. It shows how many people are genuinely interested at that price. When volume increases, it means market participants are ready to take action at that level. When volume decreases, it means market participants are indifferent or in doubt. Think about it. If the price is going up, but the volume isn't increasing, will that movement be sustainable? Absolutely not. This movement is hollow, empty from the inside. On the other hand, if the price goes up and the volume also increases, it means buyers are genuinely behind that movement. This is the difference between a weak rally and a strong rally. Now, you might be thinking, is volume always this simple? The answer is no. To understand volume, we need context. Every candle, every price move is linked to previous moves. Volume analysis means reading this context. The author says that volume analysis is not just a part of technical analysis, it is its foundation. Indicators, oscillators, moving averages, they all come later. But if you understand the relationship between volume and price, you can feel the pulse of the market without any indicators. Let's move to a real-world application. Suppose you want to trade a breakout in the stock market. There's a resistance level on the chart and the price is approaching it. Most people, seeing only the price, get excited and take an entry. But if you are a volume analyst, the first thing you'll look at is the volume. If there's not much volume during the breakout, that breakout is worthless. It's just a trap. On the other hand, if the volume suddenly increases with the breakout, it means a crowd of buyers is supporting that movement. This breakout is real. This same principle works in marketing and business decisions. Imagine you're launching a new product. The price is your decision. You can keep it high or low. But the real question is, how many people are genuinely ready to buy at that price? That's volume. In market research and demand analysis, customer response is measured just like volume. High engagement tells a different story. For example, if the market is going up, but the volume is continuously decreasing, it means the rally is getting weaker. Participants are backing off. Such movements usually don't last long. Similarly, if the market is falling, but volume isn't supporting it, it means the sell-off isn't genuine. The author says that volume analysis gives you two powers: clarity and confidence. Clarity because now you know where real investment is happening in the market and where only noise is being created. Confidence because when you trade, you won't be afraid if this movement will last because you have already seen its foundation from the volume.
Now, if we talk about the practical side, you just need to focus on two things at the beginning. First, compare the price movement with the volume movement. Second, look for abnormal volume spikes, that is, a sudden large increase in volume. These spikes reveal the market's true intention. Sometimes it's the action of big players and sometimes it's the panicked crowd. A volume spike tells you that the market is not normal now. Something big is about to happen here. This is the opportunity where traders make the most profit if they stand on the right side at the right time. Remember, volume analysis is not a shortcut, it's a skill. Just like when you learn a new language, you first have to learn letters, then words, then sentences. Similarly, you first need to understand the volume bar, then the patterns, and then the story of the entire market. The author mentions another important point here: patience. Volume analysis will only work when you're patient, because many times volume builds slowly. If you hurry, you will miss the signals. The real benefit of volume comes when you observe and wait until the market itself gives you a clear signal. Volume analysis also changes trading psychology. Most traders are stuck between fear and greed, but when you see from the volume what is happening behind the scenes, a kind of peace comes to you. You make fewer emotional decisions and more logical ones. And this is why the author says, volume is the truth. Price can lie, but volume never does. Chapter 1, Part 2. When we trade in the market, the very first thing that comes forward is the connection between volume and price. The author repeatedly says that price doesn't say anything alone. The real story of the price is created together with the volume. Imagine if the price of a stock is going up, but the volume is very low. This movement will not be sustainable. It's a temporary rise that can reverse at any moment. But if that same price goes up and the volume also increases, it means that the big players of the market, that is, smart money, are showing interest in this stock. This is a sign of real strength. The author says that trading is not just a game of looking at charts, but a game of understanding the psychology behind the charts. Volume tells us who is behind the market. Is it just small retail traders pulling the price up, or are big institutional investors also involved? This is the difference between a real trend and a fake one. This is why volume analysis is called the heartbeat of the market. Now suppose the price of a stock is holding at a support level repeatedly, and every time it tests the support, the volume is higher than before. This means that buyers are very strong at that level. Now if that stock jumps up from that support, it is not just a technical movement, but proof of market strength. Conversely, if a resistance is being broken but the volume is weak, this breakout will not last long. The author also makes an interesting point that ignoring volume is like looking at a person's body but not listening to their heartbeat. Without a heartbeat, the body has no life. Similarly, without volume, a price movement has no real strength. The biggest mistake for traders is that they only look at price action and ignore volume. But real success comes when you read both together. This combination shows you the true direction of the market. So the author says that if you learn to understand volume and price, you have found the key to decoding the market, because the real reason for every rise and fall in the market is hidden in the relationship between these two.
Chapter 2, Part 1. Now that you have started to understand the basics of volume and price analysis, in this chapter we will talk about the patterns that often give deep information about the market's direction and its movement. Identifying patterns in trading is like a doctor diagnosing a disease by looking at a patient's heartbeat, blood pressure, and reports. Here, the disease means the market's uncertainty and its hidden moves. First, let's understand how volume and price together give us reliable signals. Suppose the price of a stock is slowly going up, but the volume is very low. It's like trying to drive a car downhill without putting petrol in it. The car might start moving, but it won't go far. On the other hand, if the price is going up and the volume is also increasing rapidly, it's like filling the car's tank with full petrol, allowing the car to last a long race. The author states that many times small volume signals pave the way for big changes. For example, if a stock suddenly gets an unexpectedly large volume, it could be a sign that big players are taking a position in it. And when big players take a position, a big move in that stock can almost be considered certain. But for this, we not only have to focus on volume, but also on the price pattern. A key pattern here is the volume spike. When volume suddenly increases all at once, and the price also moves strongly in the same direction, it often signals the start of an upcoming major trend. But if the volume suddenly increases, and the price gets stuck in the same place, or moves very slightly, it alerts us that something might be going wrong inside. Similarly, the divergence of price and volume is also an important pattern. For example, the price is going up, but the volume is decreasing every time, which indicates that this upward move is fake and can reverse quickly. This is why professional traders don't make decisions based on price alone, but always look to see if the volume is supporting that price. The purpose of this chapter is for you to understand that patterns are not just a game of lines created on a graph, but they are actually a glimpse of the market's psychology. Volume tells us how many people are involved in that move, and price tells us which direction that move is going. When the two combine, confidence in the trade increases many times over. Chapter 2, Part 2. Now think a little. When you are working on a chart and you think you have understood everything, the market suddenly breaks your assumption. It's just like when we read half a book and assume that we know the whole story, but the real twist always comes later. The author wants to explain here that until we understand the whole context, it can be dangerous to rely on any pattern or price movement. Many traders make this mistake of making a decision after looking at one or two candles. For example, if a stock suddenly goes up, it can be a big mistake to immediately assume it's a breakout, because without looking at volume analysis and the background trend of the market, you cannot make the right decision. Another important thing is that the market's movement is not always linear. That is, if you think that the stock is rising, it doesn't mean that it will go up continuously. Rather, it will stop many times in the middle, retrace, and then take a new direction. This is the natural rhythm of the market. The author says that we should learn the art of understanding these ups and downs. The real problem is that we traders often lack patience. As soon as a little profit is seen, we immediately book it. Or if a little loss happens, we get scared and exit. But the truth is that big moves are caught by those who understand the harmony of volume and price and wait for the right time. Here comes another important point: fake signals. The market often tries to confuse us. Sometimes you will feel that it's a strong breakdown, but in the next hour the price reverses. Sometimes you will feel that the market is about to fly high, but a sudden fall comes. Therefore, the author repeatedly insists that you cannot just look at the price. You have to look at volume and the market background together. Only then can you differentiate between real and fake movements. Ultimately, the main message of this part is to understand the market like a flowing river. It is constantly changing, but with a deep understanding, this map gradually becomes clear. And when this map becomes clear, you can make big and confident decisions. Chapter 3, Part 1. The biggest mistake many new traders make when trading in the Forex market is basing decisions solely on price movement. But the real game lies in understanding both price and volume. The author states that by looking at price alone, you get incomplete information. But when you learn to read price with volume, you gain a deeper understanding of who's winning in the market: the big players, the smart money, or the small retail traders. For example, imagine you see Euro USD suddenly start to rise. At first glance, it seems like a great buying opportunity. But when you look at the volume and see that it's very low at that moment, this movement is often unsustainable. This means the big players aren't part of this movement, and it's likely just a short-term reaction from small retail traders. On the other hand, if that same movement occurs with high volume, it means big players also have an interest in the market, and this trend could last for a long time. The author repeatedly emphasizes that volume gives price validation. Price is incomplete without volume, and volume is useless without price. When the two are understood together, the true nature of the market is revealed. Especially in the currency market, where trillions of dollars are traded daily, trading based on price alone can be risky. To further clarify this point, the author gives another example. Suppose GBP USD suddenly falls during a specific news event. If you only look at the price, it might seem that it will fall further. But if you look at the volume and see that it's unusually high at that moment, this movement is likely temporary because big players are taking advantage of this drop to buy, meaning the price decline is temporary. And the volume is giving you a warning that the true direction might be up. This is why the author says that understanding volume price analysis is crucial. It not only saves you from fake moves and short-term traps, but also helps you recognize the market's true direction. In fact, it moves your trading strategy from being based on mere speculation to a solid foundation. Chapter 3, Part 2. Now consider that millions of transactions happen in the market every day, but only a few of those opportunities give rise to a true trend. This is why volume price analysis gives us a kind of filter. It tells us which movements have real strength and which are just noise. When you look at the direction of the price alone, it's an incomplete picture. But when you look at price and volume together, you see the real truth. For example, imagine a sudden big drop in a stock, but the volume is much higher than normal. What does this tell you? It means many large investors and institutions are exiting the stock. So this drop is strong and real. On the other hand, if a stock falls but the volume is very low, it might be the result of panic from retail investors, and in such cases, the drop doesn't hold much significance. Another interesting aspect of volume price analysis is that it gives us clues about accumulation and distribution. Accumulation means large investors are slowly buying a stock without letting the price rise too much. This often happens when volume increases, but price movement is limited. Distribution is the opposite, where large investors are slowly selling their stock without letting the price fall too much. Understanding this process is extremely important because it lays the foundation for future big moves. Now let's talk about breakouts and false breakouts. This is an area where most traders get stuck. Often you see a stock break out of its range and suddenly run up. Many traders jump in immediately, but after a short time, the stock falls again and they lose money. This is called a false breakout. If the question is how to differentiate between a real and a fake breakout, the answer is volume price analysis. If the volume during the breakout is much higher than normal, there's a high probability that the breakout is real. But if the volume is weak, it's just a fake surge designed to trap retail investors.
The biggest advantage of volume price analysis is that it works in any time frame. Whether you're day trading, swing trading, or investing for the long term, the relationship between volume and price will always show you the right direction. This is why professional traders never read a chart based on candles alone. They always look at the volume bars as well. You can understand this strategy as a kind of market language. Price is the words the market speaks, and volume is the tone in which it speaks them. If you only listen to the words, you won't understand their true meaning. But when you listen to the tone along with the words, you'll guess the truth. This is the essence of volume price analysis. It helps you find what is hidden below the surface. Now, it's impossible to lose. But history testifies that most of the great traders who have fallen because of this arrogance and overconfidence. This is the most dangerous trap in trading, judging your own abilities to be greater than reality. The market is always changing. It never moves according to your expectations. And if you believe you know everything now, that is when your downfall begins. The author states that overconfidence appears in many forms. For example, after a series of continuous profits, a trader increases their position size, bets on a trend that goes against their rules, or starts to take risk management lightly. They feel that there's no way they'll lose because they'll be right every time. But the truth of the market is that no matter how much of a master you become, losses will always be a part of trading. And when you start to ignore risk, that loss becomes so large that your entire account is wiped out. This is why the author repeatedly emphasizes that humility is a trader's greatest strength. A good trader always assumes they could be wrong. They assume in every trade there's a 50% chance their analysis will be proven wrong. Therefore, they never put a large portion of their capital on a single trade. Their focus is solely on how much they'll earn if they're right and how much they'll lose if they're wrong, and whether they can easily tolerate that loss. If we look at it, the psychology of overconfidence is very interesting. When people win continuously, dopamine is released in their brain, which is a kind of reward chemical. This encourages them to take more risks. In this situation, people don't think. They make quick decisions under the influence of adrenaline and dopamine. This is why many traders lose everything in one bad trade after winning 10 or 15 in a row. So the real discipline is to remain calm when you are winning and when you are losing. The author says that if you want to save yourself, you need to design your system to be anti-overconfidence. For example, predetermining your position size limit, sticking to it without increasing risk after 3 or 4 consecutive wins, and taking a 2-day break after every big profit to calm your mind. All these small steps save you from the trap of overconfidence. Sometimes traders think that overconfidence only happens to new traders. But the truth is, this disease is more common among experienced traders because experience gives them a greater sense of "I am right." But the real master is one who is never arrogant in front of the market and considers every day a day of learning.
Chapter 4, Part 2. Now that we have understood the reality of trading and the truth of trading, the next important aspect is to maintain your mental balance and survive in this game for a long time. The foreign exchange market, which is often called the largest and most liquid market, cannot be conquered with technical knowledge alone, but with the discipline that keeps your mind and heart stable. Here's an interesting point. Many traders come to the market initially, create a great strategy, have a few successful trades, and feel like they have cracked the market's code. But then a sudden wrong decision or an unexpected event crushes all their hard work. This is where the real game begins. The real trader is not one who just makes a single correct trade, but one who recovers from a wrong trade and comes back to the field stronger. The author emphasizes that to be continuously successful in the foreign exchange market, you need mental fortitude. Here you have to accept that loss is a part of this game. If you are paralyzed by the fear of losing every time, you will never have the courage to win. Instead, you need to consider a loss as a trading expense, just like a business person's rent or electricity bill. Along with this, the author gives us another great lesson: patience in trading. People often think that more trades mean more profit, but the reality is that the market rewards those who know how to wait. Waiting for the right opportunity is the real art. Opportunities don't come every day in the market, but when they do, you have to be ready. This readiness is not limited to just reading charts or understanding economic news. It is also at the mental level. Suppose you look at charts all day, create a strategy, and as soon as you see a pattern, you jump in. But the real question here is that pattern really strong, or are you just getting impatient and trapping yourself? This is where patience is tested. Successful traders are those who ignore hundreds of opportunities and only take that one opportunity where their chance of success is highest. Another essential aspect is emotional control. When trading, greed and fear are two emotions that surround every person. When you are in profit, greed says to wait longer for more profit. When you are in a loss, fear says to get out now or you'll lose everything. If you don't control these emotions, no matter how great your strategy is, in the end, a loss will be waiting for you. So the author says that trading is not just an economic activity, it is a mental discipline. As long as you don't control your mind, you can never control the market. This is why foreign exchange trading is called both an art and a science. Finally, the author helps us understand that if you want to survive in the market for a long time, it is essential to maintain stability and discipline in every decision. The temptation to get rich quickly or the fear of a small loss can end your entire career. Trading is not a sprint, it's a marathon, and the one who is patient and disciplined completes this marathon.
Chapter 5, Part 1. In the world of trading, a very big factor is liquidity. Liquidity doesn't just mean how many people are trading in that market, but also how much demand and supply for buying and selling exists at a particular price level. Many times, traders just look at a chart and think the market will go up or down, but the real movement happens when liquidity becomes active at a specific level. The author tells us that understanding liquidity is like understanding a river's current. Water always flows through the path of least resistance, and the market also always moves in the direction where there are the most orders and volume. For example, at a specific level, let's say 1.1 thousand, the market repeatedly stops. This becomes a level where traders place a large number of stop losses. When these stop losses are triggered, the market suddenly moves rapidly. This is the effect of liquidity. Large banks and institutional traders often identify these levels and build their positions from there. Small traders think the market suddenly spiked without any reason, but the real truth is that a big player took advantage of the liquidity to fill their orders. This is why trading by just looking at a trend isn't successful. You also have to see where liquidity is hidden. From volume profiles, order book data, and price action, you can estimate where big players might become active. For example, understanding liquidity can be an advantage for retail traders. Even if big players don't have inside information, by reading their patterns and movements, small traders can catch the right direction. If you can identify liquidity in the right place, your entry and exit points become more accurate, and the risk of trading is greatly reduced. Chapter 5, Part 2. Now we'll talk about the mistakes that constantly force a trader to weaken their abilities. Many people view trading as a shortcut to making money. They think that one correct trade will change their life. But the truth is, this mentality slowly pulls them towards failure. In this part, the author explains why professional traders always focus on the process, not just the result. Think about it. If a doctor focuses only on the success of an operation, but forgets the process, the right tools, the right technique, and the right precautions, can he save the patient's life? Absolutely not. The same thing applies to trading. If you only focus on profit and forget the process, risk management, correct entry, exit strategy, and discipline, a loss is guaranteed. The author says that the real victory happens when you continuously improve your mindset. When you trade, it's important to understand that every trade doesn't have to be right. Real success is continuously making correct decisions. These decisions are what grow your account in the long run. In addition, traders make another big mistake, which is trading based on emotion. Many times, greed, fear, or impatience pulls us into wrong trades. After a small loss, we try to recover it quickly and end up with a bigger loss. Or, after a small profit, fear causes us to close the trade early. In both these situations, the real profit slips away. The author makes a crucial point here. If you want trading to be profitable for you in the long term, you have to continuously work on your mental game. Trading is not just a game of charts and numbers, it is also a game of your mind and emotions. As long as you don't control yourself, you can never understand the market. So, this part of the chapter teaches us to take every trade as a lesson. Whether you win or lose, learn from it and apply it in your next decision. If you can do this, gradually that fortitude will develop within you, which will make you a professional trader from a normal one. Chapter 6, Part 1. Up until now, we've understood how the relationship between volume and price brings the true picture of the market to light. But now it's time to focus on an extremely important aspect, the trend and the signals hidden within it. Identifying trends in any market is most essential because a trend tells us in which direction money is flowing. Whether it's an uptrend, a downtrend, or a confusing sideways movement, every trend has its own distinct story and signals. The author teaches us that a reliable guess about a trend can never be made by looking at price alone. Rather, the correct picture emerges by combining price and volume.
For example, if a stock has a continuous upward movement but weak volume, it could be a false uptrend. In other words, the stock looks bright on the surface, but there's no real investor strength behind it. On the other hand, if the price is falling but the volume is also continuously decreasing, it indicates that the fall may gradually stop because the selling power is running out. Here the author also makes another important point.
Don't look at a trend only from the perspective of up and down, but identify the hidden patterns and signals within it. For example, a stock that is continuously rising and getting support with more volume at every new level is a clear indication that professional traders and large institutions are building their positions in that stock. If this uptrend is accompanied by light volume, it could be just a rush of small investors, and the risk in it is much higher. This is why the author repeatedly emphasizes that the most correct way to understand a trend is the combination of volume and price. Trading by just looking at arrows on a chart or accepting someone else's opinion can push you toward a loss, whereas when you also analyze volume yourself, the real signals are also hidden, like a sudden increase in volume which could be an indication of a new trend starting, or a sudden decrease in volume during a falling price which could mean the market is close to bottoming. Reading these small signals is the real power of volume price analysis. The gist of this section is, never rely on just one thing in the market. The real story always comes to light from the combination of volume and price. It can also give us a hint of an upcoming change even before a trend starts. This is where knowledge and practical experience meet to take trading to a professional level. Volume itself is not just a number, it is the sound of the crowd that is driving the market. For example, if a currency pair suddenly sees an increase in volume and the price also moves in one direction, it tells us that institutional investors are building their positions there. But if the price doesn't change much and the volume continuously increases, it could be an indication that a big movement is about to happen in the market very soon. This is called a situation of accumulation or distribution. Accumulation means big players are slowly buying, and distribution means they're slowly selling and getting out. Volatility is equally important. It tells us how much and how fast the price is changing. A high volatility environment is like a double-edged sword for traders. There are big opportunities for profit, but the risk is just as big. A low volatility environment seems more stable in contrast, but many traders can get trapped if a sudden breakout occurs. Here the author says that a successful trader is one who knows how to read volume and volatility together. Making a decision by just looking at candles formed on a chart is incomplete. For example, if a long bullish candle forms with high volume on a currency pair, it could be an indication of a strong uptrend. But if that candle is formed with low volume, it could also be a false signal. Similarly, volume tells us how much stability there is in that trend. In fact, volume and volatility are like the heartbeat of trading. When we learn to listen and understand these, we become better traders.
Chapter 7. Situations of uncertainty, fear, greed, and excitement arise. Here, victory is for him who can make the right decision by keeping his mind calm. Suppose you have placed a trade on a currency pair, and in the first few minutes the price has gone against you. At this time, most new traders get scared and either hastily close the trade or hold it until the loss increases. But professional traders know that the real fight is not with the market, but with their own internal fear and instability. Therefore, they predetermine their risk, place a stop loss, and follow that plan. Professional traders also know that greed and overtrading are a trader's biggest enemies. Many times a trader feels that he has made 2 or 3 profitable trades in a row, so now every trade will be profitable. This very thought forces him to take repeated entries without any analysis. As a result, slowly all the hard work and profit get washed away in a big mistake. The other side of mental fortitude is patience. The currency market is open 24 hours a day, and something is happening every moment. In such a situation, new traders feel that they should profit from every movement. Yet, real success comes only when you learn to wait for the right opportunity. Patience does not mean that you do nothing, but it means that you take action at the right time according to your strategy and analysis. The author says, if you attach every trade to your ego, fear, or hope, you will make most of the mistakes. But if you attach every trade to the system and rules, it becomes easier to make continuous profit in the long run. This is why successful traders keep their trading journal, write down their mistakes, and evaluate their mental state every day. They know that opportunities will keep coming in the market, but to seize them, it is essential for their mind to be calm and focused. Chapter 7, Part 2. When we go deep into volume and price analysis, we understand that every movement in the market is not just a number, but behind it lies the psychology, hope, and fear of thousands of traders. This is why the author tells us in this part, don't look at the price chart and volume just as data, but look at it as a story. When the price of a stock suddenly goes up fast, but the volume is very low, it can be a fake move, which is often called a false breakout.
On the other hand, if that price is rising and the volume is also rising with it, then it is an indication of real demand. Here, the author also explains to us that the relationship between volume and price sometimes gives us a heads up about big upcoming changes in the market. For example, when the market stays in a sideways movement for a long time and suddenly the volume starts increasing, it can be an indication that the market is about to go towards a new trend. Many times, traders make wrong decisions by only looking at price patterns, but if they also pay attention to volume, they can understand the real message hidden behind that pattern. The author emphasizes another important thing, and that is divergence. If the price is continuously going up, but the volume is decreasing at every new high, it indicates that the strength of that uptrend is ending. This is often a signal of the beginning of a big reversal. Similarly, when the price is falling, but the volume is decreasing, it indicates that the selling pressure is weakening and the market may turn upwards now. In this part, the author also teaches us that successful trading does not just mean seeing data, but reading it. Every candle, every volume bar tells us a story, and if we read that story carefully, we can be one step ahead of other traders. This skill comes only with experience and requires patience and continuous practice. In the end, the biggest lesson of this part is that volume price analysis gives us an additional dimension to understand the market's movement. Where price alone shows us an incomplete picture, volume completes it and tells us where the real power is coming from. This is why traders who look at both volume and price together can make decisions with more prudence than others in the market. When we talk about volume and price analysis, a very important aspect comes here: the depth of the market and the hidden signals. Often it happens that we only focus on the movements visible on the surface, but the real strength or weakness is hidden inside. This is why the author explains to us that the combination of volume and price is not just chart lines and bars, but it awakens the real psychology of buyers and sellers. Imagine a stock is continuously going up, but the volume is decreasing. This might look good to the person seeing the surface, that the price is increasing, but the truth is, there is not enough big money present to believe in that movement. This move is often not sustainable and can fall on slight negative news. In contrast, if the price is going up slowly and the volume is also steady or increasing, then it is a signal of a healthy uptrend, because here there is support from smart money. The author also says here that traps are a part of the market. Many times, big institutional players intentionally take the price up or down to trap small investors. For example, when the price suddenly goes up fast and the volume also increases, retail traders get excited and start buying. But after a while, that price suddenly comes down and small investors get scared and sell. This process is called distribution, where big players sell off their positions and exit. Another important aspect is that volume patterns change with time. Volume is highest during the market's opening and closing hours, while it is often low during the middle hours. So, while analyzing any volume, we should see if the increasing volume is a normal increase or abnormal. If there is a sudden increase in volume outside the normal pattern, then it is definitely a signal of a big move. Similarly, the author says that the combination of price and volume often helps us understand breakouts and breakdowns correctly. If a range has been forming for a long time, and suddenly the price breaks out of that range, but the volume is weak, then it can be a false breakout.
But if that move happens with strong volume, then it is a real breakout and can continue for a long time. Finally, the author's emphasis in this part is that it is essential to have patience in trading. Making a decision by only looking at the price is wrong. We must understand the real story hidden behind the volume, because this story tells us who is winning the game, smart money or scared retail investors.